When it comes to investing, we spend so much of our time and energy trying to find that next big thing, right? That one stock that's going to take off. But what if I told you that the real secret to long-term success isn't just about the winners you pick? It's about the disasters you avoid. It's about learning to spot the traps before you step in them. Because sometimes the smartest move you can make is knowing exactly what not to do.
The famous boxing trainer Angelo Dundee said it perfectly. A great fighter isn't just focused on landing that knockout punch. They're obsessed with defense, with dodging the hits that can knock them off their feet. And that idea, it's a perfect fit for investing. A couple of really big losses can completely wipe out years of your hard work. So the key isn't just playing offense. It's about having an incredible defense and avoiding those devastating hits to your money.
And building that strong defense is exactly what this video is all about. Welcome to another session on investment basics, drawing from the extensive research of Mr. Majid Butt, who is an accountant, a software programmer, and an investment researcher. We're going to give you the tools you need to protect your portfolio and navigate the markets with a whole lot more confidence.
So here's our game plan for today. First, we're going to talk about a guide to avoiding risk and why a negative approach can actually be a huge positive. Then we're diving deep into the high-yield bond trap. After that, we'll navigate the tricky waters of foreign government bonds. And then, oh yeah, we're going to tackle the danger of new issues or IPOs. Finally, we'll wrap it all up with a clear summary of what to avoid.
All right, let's kick things off with our core idea, avoiding risk. Now, I know this might sound a little backward, but for any investor who's serious about building wealth, taking a negative approach, that is, focusing on what to steer clear of first, can be the most positive and powerful strategy you have in your arsenal.
So what does that actually mean? Well, it's pretty simple. You filter out the bad ideas first. Before you even start thinking about what you should buy, you need to identify and just completely eliminate the types of investments that are full of hidden dangers. By just avoiding those few big traps, you automatically boost your odds of success with everything that's left.
All right, let's talk about our first major pitfall, the high-yield bond trap. You've probably heard of these. They're often called junk bonds. And boy, do they sing a beautiful song promising all this amazing income. But as we're about to see, that beautiful music can lead you straight into some very sharp rocks.
So, what is a junk bond, really? Well, think of it as a loan you're giving to a company that's, let's just say, not top of the class. It has a lower credit rating. And because that company is seen as riskier, it has to promise to pay you a higher interest rate, a higher yield, to get you to lend it your money. It's a straight-up trade-off. You get a little more income, but you accept a much bigger chance that the company might not be able to pay you back at all.
Now take a look at this, because it lays out the choice so clearly. On the left, you've got that tempting junk bond, dangling an 8%, maybe even higher, yield in front of you. On the right, you have a high-grade bond from a super stable company, maybe offering 5%. That extra 3% looks amazing, doesn't it? But look at what you're giving up. Your safety is low, and the risk of default is significant. With the high-grade bond, your safety is high, and the risk of losing your money is practically zero. You have to ask yourself, is that little bit of extra income really worth the risk of losing everything?
And this quote just nails it. It is terrible business to accept a real, known possibility that you could lose a huge chunk of your original investment just to squeeze out an extra 1 or 2% a year. Think about it. One big loss of your principal makes all that extra yield you collected completely pointless.
To see just how badly this can go wrong in the real world, we need to look at a classic case study, the collapse of WorldCom. Now, this wasn't some tiny unknown company. This was a giant in the telecom industry, and its story is a perfect and painful example of the high-yield trap in action.
Let's walk through this timeline, because the warning signs were flashing bright red. In May of 2001, WorldCom sold almost 12 times billion dollars in bonds. The yields were great, up to 8.3%, and even the pros piled in. But here's the kicker, hiding in plain sight. The company wasn't even making enough money to cover the interest on the debt it already had. It was a house of cards, and just a little over a year later, the whole thing came crashing down.
And the final result for all those people who chased that attractive 8.3% yield? They lost more than 80% of their money. All that extra income they earned for a year or so was just gone, wiped out 100 times over by the loss of their initial investment. That is the brutal reality of the high-yield trap.
This idea of hidden risk doesn't just stop with companies. Let's talk about foreign government bonds. Lending money to a whole country, that sounds super safe, right?
especially when they're offering better interest rates than what you can get at home. But as we're about to see, those attractive yields can hide a whole world of risk.
Here's the thing you absolutely have to understand. When you lend money to your own government, you've got legal protections. But when you lend to a foreign government and that country runs into some kind of political or economic crisis, what are you going to do? The answer is pretty much nothing. You have no real legal power to enforce your claim. You are 100% at the mercy of that country's stability and its willingness to pay you back.
And just to show you how insane this can get, look at the history of this 8% bond from Czechoslovakia. It was a roller coaster that lasted for decades. It started out fine, then soared, and then collapsed almost nothing. Then, you won't believe this, it recovered to an all-time high after the war, only to crash again just 2 years later. Eventually, it was trading for just 8 cents on the dollar. This isn't investing, it's like geopolitical roulette.
And hey, this wasn't a one-off thing. Look at these other examples. Bonds from Cuba, the Belgian Congo, Greece, Poland, all of them saw devastating collapses. These stories just repeat themselves over and over again throughout history. That promise of a slightly higher yield from a foreign bond is almost never worth the risk of losing nearly everything.
All right, let's shift gears and talk about one of the most exciting and maybe one of the most dangerous areas for investors, new issues. Specifically, initial public offerings, or IPOs. This is when a private company sells its stock to the public for the very first time. And the hype, well, the hype can be absolutely deafening.
So let's just get right to it and ask the big question. Are IPOs really the golden ticket? We all hear those amazing stories, right? About people who got in on the ground floor of the next huge tech company. The media just loves those stories. But is that the reality for the average person? The data says not even close.
Here's why you need to be so careful. It really boils down to two huge problems for you, the buyer. First, there's a massive sales and marketing machine pushing these things. The investment banks make enormous fees selling them, so they're going to do everything they can to get you excited. And second, companies choose to go public when the market is red hot, so they can get the absolute highest price for their shares. So by definition, you are almost always buying at the best possible time for them, the seller, and one of the worst possible times for you, the buyer. And all this IPO hype? It feeds into the worst possible habit for an investor, jumping in and out of stocks, trying to catch the next big thing. This chart shows why that's a total disaster. A study looked at thousands of investors and found that the patient ones, the ones who hardly ever traded, did great. But the hyperactive traders, the ones chasing IPOs, their returns got completely eaten alive by costs and bad timing. They did way worse than the market. Let's put a real number on this because it's pretty shocking. The more you trade, the less you keep. It's that simple. When you factor in commissions, taxes, and other costs, an active trader often has to make a 10% profit on a trade just to break even. That's a massive hurdle to clear again and again, and almost nobody can do it successfully.
Okay, but what if you just buy and hold the IPO? Forget about trading costs for a second. Well, the data here is just brutal. A huge study over 20 years found that if you bought the average IPO and held it for 3 years, you would have underperformed the rest of the market by an average of 23% every single year. The numbers don't lie. As a group, IPOs are a terrible long-term investment for the public.
And if you need that one perfect example, that poster child for IPO madness, we have to talk about the legend of VA Linux. This story is the absolute peak of the dot-com bubble, and it shows what happens when hype gets completely disconnected from reality. Just look at these numbers. The insiders, they got the stock for $30 a share, but the hype was so insane that on the very first day of trading, it opened at $299. It closed the day at over $239, a nearly 700% gain in one day. But what happened to the regular folks who bought into the excitement? Well, 3 years later, that same stock was trading for $1.19, a complete wipeout. It was a lesson in the massive difference between a popular price and a company's real value.
So, to help you remember this lesson, here are a few other things IPO can stand for. How about it's probably overpriced, or imaginary profits only? My personal favorite, insider's private opportunity. Or for those really spectacular flameouts, idiotic, preposterous, and outrageous. Keep those in your back pocket for the next time you hear about a can't-miss IPO.
Okay, we've covered a ton of ground here. So let's pull it all together and summarize what an intelligent investor needs to avoid. Think of this as your personal defensive checklist to protect your capital.
So let's lock these 4 rules in. Number 1. Resist high yields from low-quality bonds. The risk is just not worth the reward. Number 2. Be really wary of foreign bonds. You have very little power if things go south. Number 3. Avoid the IPO hype. Let other people play that game. It's rigged against you. And number 4. Stop being a hyperactive trader. The evidence is crystal clear. The more you trade, the less you keep.
And so I want to leave you with one final question. A question you should ask yourself every single time you think about making an investment. Are you buying this because you want to own a piece of a valuable, real business for the long haul? Or are you just buying it because it's popular? Because you're seeing it everywhere and you've got that fear of missing out? Your answer to that question will make all the difference. I really hope this video has given you a strong foundation for building your own defensive strategy. Now, if you want to learn how to go on offense and how to analyze the great businesses that are left after you've avoided all these traps, I'd invite you to subscribe to the membership. You'll get access to exclusive videos where we do deep dive analysis of the financial statements of public companies listed on stock exchanges all around the world. Thank you so much for watching,